Good morning, Jags. This is Fahad. Today is Friday, November 20th. Let's get started. This is a Netflix chart in front of you, and I think it's time for this stock to pop. Let's see if that happens today or if it happens early next week. Purely from a short-term technical standpoint, important thing about this stock is that technically this has once again come back and it's resting at that very same important support level where it has done so last multiple times. You can see each time it has pulled back to 460 to $470 range. It has bounced off this level, multiple U-turns from this level. And I think that one of those U-turns is coming soon, and we could start to see that beginning from today. Similarly, MACD has come down, corrected with a bull cross, and I think we're going to see that bull cross pretty soon. Here's another way of taking a look at it. This is possibly a better technical picture. You can see that each time it comes down, it bounces around, it builds a base, and then boom, we break out. Volume comes in and we break out and we get the MACD bull cross and the RSI bull cross. Then once again, it comes down, it bounces around, volume dries up, and then we again gets a surge of volume and it breaks out. And I think this is the third time. At a minimum, if this technically starts to break out, I would expect this gap fill up to $520 per share come pretty soon. But beyond that, I think the stock easily could rally all the way back to $550 to $560 per share. So on a percentage basis from here, that's 10 to 15% of upside. So keep an eye on Netflix. Now, I bring this up because we have an update now. Recall, this company announced a price hike in several different countries, particularly in the United States, on October 29th. For every pricing tier that the company has, on October 29th, they raised prices for their premium packages, and they did the exact same thing a couple weeks prior to that in Canada, so on October 8th. So as a result, the average pricing for their premium packages, all of them combined, has now moved higher from $13.32 to $14.49. That's an increase of about 10%. Now, the risk that everybody thought that this company had after their price hike was that we will potentially start to see a sharp uptick in the churn rate. And as a result, the stock initially surged on the price hike announcement, but then corrected quickly. We have an update on that one now, and basically it's telling us there is no surge, there's no increase in the churn rate at all. In fact, churn rate continues to come down after that backlash that happens from that French production, which caused a lot of anxiety on social media called cuties. So according to Antenna, which is the third-party channel checks that provides this data, the October data shows US Netflix churn rate was actually down month over month to a monthly rate of 3.12%. And the cuties backlash in September caused the churn rate to go as high as 5.77%, which was the highest we have seen from the company for a long period of time. But that churn rate now continues to come down, ended the October at 3.12%, and it is now likely actually heading back to its lowest point that we saw, which was about 2.54% about 2 years ago. And similarly, if you look at Canadian data, in Canada, where the price hike was announced on October 8th, we have not seen the churn rate actually go up. This is very positive for Netflix because the growth should remain quite strong with net sub additions, particularly in the international market, quite strong, while the churn rate is not going up. So all that price hike basically drops all the way down to the free cash flow line. So the forward earnings estimates are going to start to tick higher materially with the churn rate remaining low. As a result, this is a precursor to a potential re-rating in stock for more upside. So let's see if this will start to break out technically from here. And in short term, I expect a move up to $520 to $530 per share. So that's on Netflix. Second stock real quick is INMD, the former Jaguar top pick, INMD. This was about a year and a half ago. This is when we presented the bull case for INMD. It was made a topic in the Jaguar first quarter 2020 outlook, or was it first quarter? I can't remember exactly which one it was. But anyways, after this was made a topic, I went to New York State to make a presentation to a group of investors, and I made a big pitch to all of them to get long INMD. And then also in the same trip 2 weeks later, I came back and then I went to another presentation in Troy, Michigan, and I made a big case to get long in mode. This was all after this was made when we were very, very bullish on the stock, and we made a ton of money back then, about a year and a half ago. So all over here. And then naturally, as COVID happened this year, like everything else, this one came down. This one now has a technical breakout pattern in very short term. Look closely. This $45 level is a major VOP resistance level. Now, interestingly, the day the company announced earnings, which was last week on Friday, so it's been a week, the stock didn't really have a reaction at that point to what was clearly a very, very strong quarter. But now we're starting to see late surge in the stock as some senses come back, and the stock is starting to act very strong. This is starting to break out from this tight bull flag. If it clears this $45 resistance, I don't think there's much on its way to gradually climb all the way back to new 52-week high, which would be all the way above $55 per share. Naturally, not in a straight line, but should get there in a couple of weeks to a couple of months. So watch this $45 level is starting to break out. Here is another technical look at this. A simple view. You can see the volume is starting to pick up a little bit. Earnings are already out of the way. See if it starts to clear this $45 resistance. A quick word about that earnings report that came out. This company reported, despite the pandemic and disruptions and everything, get this. This company reported Q3 sales of $59 million, which was up 49% year over year. We're not talking sequential quarter over quarter, because a lot of companies are reporting quarter over quarter improvement because everything was shut down in Q2 and the businesses reopened in Q3. We're talking year over year. Sales were up 49% year over year and materially beat the consensus estimate of $38 million. Huge beat. US revenues were up 32% year over year. Outside of the United States, revenues were up 109% year over year. And management highlighted China, Brazil, Mexico, Korea, India. All of them collectively were up huge by an average of 58%. So very, very strong growth emerging both internationally as well as domestic. But on the actual product side, you want to keep in mind that this company launched 2 hands-free platforms over the past year. One platform was called Evolve, which was launched in exactly a year ago, third quarter of 2019, for hands-free skin tightening, fat destruction, and muscle simulation for the body. And then a second platform called Evoke was launched in the first quarter of 2020 for hands-free face and neck tightening. Both of these products have seen rapid uptake and now are already accounting for 35% of the total revenues. Given the dynamics of the social distancing and the competitive differentiation position that the company has, these 2 products should continue to provide strong tailwinds and headwinds for the company going forward for the next 12 months at least. There's also a major product that is currently in the pipeline, which we have not seen the launch yet, but that could also support further growth. That's called Morpheus 8. Morpheus 8 is used in conjunction with Morpheus 8 alone standalone platform, which was launched previously, and management now believes that this technology on the market will be able to provide full body treatment option once it launches in the next couple months. So multiple product drivers multiple product drivers are supporting the growth rate in the revenues. Expect the stock to break out and make a run gradually towards $50 to $55 per share. That's it from me. Jay?
Morning, Vod. So today I'm going to have a homepage article later today on a company we've never covered before. And that company is called Chicken Soup for the Soul Entertainment. The ticker...
That's the name of the company?
That's the name of the company. Ticker is CSSE.
Okay.
All right. So this company operates streaming on-demand networks. Just a quick background, back in March of 2019, Sony Pictures sold a majority stake in their online video business to Chicken Soup, and together they formed a new joint venture called Crackle Plus, and that is a streaming service. Now, Chicken Soup also operates other networks like Popcorn Flicks, Truly, PivotShare. Company reported their Q3 earnings just over a week ago, and they were pretty good. Viewership trends remained steady throughout the pandemic. They said that in Q3 it generated more than 155 million video streams on Crackle and Popcorn Flicks, which was slightly more than the 151 million in Q2. Original and exclusive content on their networks comprised over 16% of average monthly streaming hours in Q3, and that was up from just 2% a year ago. Distribution and production revenue was up sequentially, and this was driven by their on-demand hit called The Outpost. And then looking to their online networks segment, this saw steady viewership in the quarter due to their latest original series release called Spides, which came out on September 17th and generated over 1 million streams in the first 2 weeks. While management did not provide financial guidance for the December quarter, the company did state that based on its October performance, monthly gross revenue in Crackle Plus increased 83% from the low point, and November and December are on track to be record months. Now, the next catalyst for this stock is going to be sometime next month. There was a post-earnings note out from Northland Capital where they state that the company announced a 30-day extension of a key deadline related to Sony Pictures ownership option. This is significant as Chicken Soup looks to expand its relationship with Sony moving forward. So expect to see an announcement regarding this on or before December 14th that outlines additional collaboration with Sony Pictures.
That's very interesting. Chicken Soup for the Soul Entertainment.
That's right.
Okay. Now I am very excited to see everything else that you're going to have in their homepage article. So looking forward to that. Interesting stock. I had never heard of it until you just mentioned it. Only $200 million in market cap, 201 million to be precise. It's a very small company. It looks like their trailing 12-month revenues through September 30th was $70 million. So it's trading at just about 3 times sales, but the sales grew by 49% year over year. I'm just looking at highlights over here on my screen. The sales grew by 49% year over year during the 9 months of this year so far. Seems a pretty powerful, strong platform. And I wonder what kind of plans does Sony really have? The collaboration that you're talking about, that could potentially indeed be the catalyst.
Yeah.
Interesting company, interesting name. Looking forward to your article on homepage. Thanks.
All right.
Chronicle.
Morning, Fahad. So I've added Kirby Corporation to my watch list on the bullish side, symbol KEX. No entry yet because I think we're going to see a pullback or at least some consolidation in the near term. So I'm waiting for a better entry. If you're not familiar, this is the company that offers marine transportation for mainly oil and chemicals, plus a bit of equipment and machinery. A lot of their routes are inland, like the Mississippi River and the Gulf waterway that spans from Texas to Florida. So if you remember, Jay recently brought up a shipping company called Matson, which is very much concentrated along the Pacific and internationally. Kirby is more domestic focused. And the bull case here is that I'm anticipating a sharp inflection in inland utilization on improving US industrial activity. So BFA was out with a note on the company yesterday, upgrading, 2 days ago, upgrading to a buy. The gist of the note is that when US GDP contracted sharply in the first half of the year, it resulted in Kirby's Q3 inland revenues declining by 18% on year, mainly because of falling refinery utilization. And if we were to look at their Q1 and Q2 earnings report and management commentary, we would see that apart from an impairment charge of $340 million, most of Kirby's weakness was really driven by 2 things. The first thing was weakness in chemicals, and the other was plummeting energy sector demand. Now, on the chemical side, I've already talked about that several times with regards to the bull case on Celanese as well as Sinopec. So I'll skip straight to the energy. So BFA is saying that currently the demand for black oil and refined products is already beginning to stabilize, and barring any more risks, there's a good chance that we could swiftly return towards historical levels in 2021. But meanwhile, if we look at inland marine utilization, which is relevant to Kirby, this utilization is yet to pick up despite the improving oil outlook. Now, BFA didn't explicitly say this, but I think it's implied that it's very possible that down the road we could see a sudden upside shock to utilization, because sooner or later, energy or chemicals transportation is going to have to catch up with the accelerating industrial demand. And as a result, I think the upcoming positive rate of change in Kirby's utilization is going to be much sharper than consensus is expecting. That's my first point. My second point is that I do not anticipate a lot of new land-based pipeline projects being approved under a Biden administration, because there's probably going to be a lot of opposition from within his party. So if it's going to be difficult to build new pipelines, and at the same time we see accelerated activity in industrials and energy, then I think Kirby is going to be a beneficiary because of all their idle capacity currently. Because if we're excluding pipelines, it's actually more economical to transport oil and chemicals by barges rather than road or rail. So that's point number two. And my third and last point. So I went through Kirby's past filings, and one thing that needs to be said is that this is a company that's been becoming more and more levered. So this is pretty common in the shipping industry, where these players have been taking advantage of ultra low interest rates to build capacity. And as we can see from these two bar graphs, Kirby isn't too bad, but they're kind of similar. And this is partly because of their recent acquisitions like Stewart and Stevenson, Hickman Marine, and then more recently this year, Savage Inland. And so all of this added debt has come back to bite them. They've had to pay over $150 million in expenses since the start of the year, while their utilization has plummeted from COVID. But as I like to say, leverage always works both ways. And because Kirby has levered and gone from 1.5 times debt to EBITDA in 2015 to over 4 times today, they've almost doubled their capacity as a result. So all it's going to take is one good year of Buy America, Build America, and then all of a sudden the company is going to be able to pay back a huge chunk of its debt and start generating some free cash flow following that. So this is what I mean when I say that the leverage can be both a curse and a blessing depending on where we are in the business cycle. Like if we get reflation in both chemicals and oil, and interest rates continue to stay reasonably low, that's a powerful combination tailwind for a company like Kirby, because Kirby's term prices are tied to spot pricing. So that's the bull case. Once again, just want to stress that I'm not looking to enter right now. The stock has been a bit overbought recently, and though it did pull back a bit yesterday, I still see it either consolidating for a bit or maybe pulling back a bit more.
Yeah, I think of all those points, the point about levering the balance sheet and then watching the underlying commodity cycle upturn is a beautiful thing. Now, it's a double-edged sword. It could also hurt significantly if that bottom never comes, right? And then things get worse, because many times, the balance sheet can topple companies altogether. But on the other side, the leverage can have dramatic impact on significant amount of revenue, cash flow growth, and everything once the cycle turns in the upswing. And we could be very well in that upswing at the emergence of that in the energy sector right now. So I agree with that point. And technically too, I think it's fair to say that this is nearing resistance right now. We are, this thing has been playing ping pong between about $35 to $45 per share, went slightly above that in the recent days. So I think a modest pullback back to the low 40s or slightly above 40, below 45 could potentially provide another entry. But once this thing starts to clear all of this VOP congestion level, there's room. There's big air pockets in this name. There's room all the way up to $73 per share. Naturally, it won't go there in a straight line. It will require pretty much a lot of help from the oil sector, from the underlying commodity, as well as demand pickup. So we'll be watching all those dynamics very closely. All right, fantastic stuff. Thanks, Chronicle, and thank you, Jay. And gentlemen, everybody, have a great weekend, and we'll see you on Monday.